It's Kev with another video. This video today is mainly for first-time homebuyers. However, anybody who is maybe interested in learning more about mortgages, any kind of home buyer might benefit from this video. We're breaking down all of the different loan options and different things that I think that any buyer who is looking to purchase a home in the near future would need to know as it relates to the mortgages. So let's go ahead, get right into it. All right, the first thing that I want to talk about is the mortgage rate landscape. So kind of where mortgages are now. This is being shot in March of 2026. So kind of take this with a grain of salt, but this is just kind of giving us an idea of where things are at right now. So now you can see that mortgage rates have dropped about 100 basis points in the last year, which is just a fancy word for about 1 percentage point over the last year. Now that's actually kind of significant because that can equate to about $180 a month if you're taking out a $300,000 mortgage. So that can actually impact your monthly payment by a lot. Now you're going to see that the 30-year fixed conventional mortgage is kind of toggling right around the 6% mark. The 15-year mortgage is almost about 3/4 of a point less, but that's because the mortgage lenders are taking on less risk because the term is not quite as long. And then you can see that a 30-year FHA right about 5.84 again as of March 2026. 30-year VA, this is actually on average the one that offers the best rate, and then the USDA loan or the rural development loan, which we're going to talk about all of these loans in a little bit more detail as the video goes on. That one's right around 5.83, so about on par with the FHA mortgage. And now you can see, and I'm not going to go through each one of these. I actually wrote a very comprehensive blog article, which I will link in the description of this video if you want a really deep dive into all of the different concepts and things that I'm going to talk about in this video. But you can see that every mortgage has disadvantages and its advantages. So a good way that I like to tell people to think about when you're shopping for a home mortgage is it's actually kind of like shopping for a used vehicle. And what I mean by that is that every mortgage option is going to have its benefits and drawbacks, and it's not a one size fits all. There's not any one best mortgage option, just like there's not one best fit for everybody as it relates to their vehicle. Some people need a pickup truck. Some people need a SUV. Some people want a sports car. They all have their benefits and their drawbacks. And when you're shopping for a home mortgage, it's very similar. And you'll kind of understand that as this video goes on. So something that I found actually very interesting as I was doing my research and preparing and writing my blog article is what the buyer demographic or the buyers in the market sort of look like right now. And you can see that the average median age of the average buyer is actually 38 years old, which is up from the average of 35 years old just a few years ago. And as you can imagine, the millennials, which are, basically people who were born in the 80s, they represent almost a third of all buyers in the market right now, which represents the largest single generation that are currently buying homes. Also, 43% of all millennials are carrying student loan debt to the tune of about $18,000 of student loan debt on average. This is something that can impact your DTI or your debt to income ratio and sort of affects your buying power when you're purchasing a house. And then obviously Gen Z is representing the largest demographic of first-time home buyers. Now again, just like I was talking about, think about shopping for a home mortgage as basically kind of like shopping for a used vehicle. And obviously, there are dozens of different types of vehicles that you can purchase, and of course, there's dozens of different loan options that you can also shop. However, there are a few main ones. So we're going to talk about the main ones here. So the main mortgage options that most people are going to use is a conventional fixed rate mortgage, an FHA mortgage, which we'll dive into what that means, a VA mortgage, or a USDA mortgage, often referred to as a rural development mortgage. Now, a conventional mortgage, this is a very, very common mortgage, arguably the most used mortgage option. And so the things that you need to know about a conventional mortgage is that a conventional mortgage is not government backed. They also happen to be one of the more flexible loan options. You can take out a conventional mortgage with as little as a 3% down payment. So that's another myth, and we're going to talk about that too. A lot of people think for a conventional mortgage that you have to have a 20% down payment when you just don't. you can get them as low as 3%, 5%. For your down payment. These typically will require a minimum of a 620 credit score, and you have a loan limit of $832,750. These are typically best for people who have good credit and intend to stay in the house for a long time. Now, the other three loans are all government-backed loans. So what that means is that the lender extends a line of credit to you. However, then the Department of Housing and Urban Development will then insure that loan. So starting with the first one, we have FHA. So this is insured by the Federal Housing Administration, which is what FHA stands for. This loan requires a 3.5% down payment. It requires a minimum credit score of 580, although I have seen somewhere below 600 for a credit score get done with FHA, but it's a pretty rocky road. But technically, the minimum score is 580. The 2026 floor for an FHA mortgage is 541,287, and these are best generally for first-time home buyers. I would say that probably 80% of all first-time home buyers that I've represented in my 12 and a half year career have used an FHA mortgage to purchase their first home. Next would be the VA loan, and the VA loan is for veterans. It stands for Veterans Association, and this is for veterans or active duty military or eligible spouses. They could take advantage of this mortgage. Now, the big benefit, there's a couple of benefits to this mortgage, but one of the big ones is the fact that it requires a 0% down payment. So you can purchase a house without actually needing to have a down payment. Another thing is that the VA mortgage has no PMI or private mortgage insurance, and that's very important. And we're going to go deep into that as this video goes on too. Also, another major benefit to the VA mortgage is that on average, it has the lowest rate of all the four main options. Now, obviously, this is only for veterans or active military or eligible spouses. So this is a loan that's best for anybody who's been in the military or currently is in the military. And then the last one is the USDA loan. So we refer to this in the biz as the rural development loan. So basically, this is a loan that you can take out, but the main limiting factor is that you can't purchase any home that's within the city limits of any particular city. However, it generally will qualify for most outlying communities just as long as they're not in the city. So now obviously the USDA loan is for suburban or rural eligible areas. This one also requires a 0% down payment. So this is another option in which you can purchase a house and it won't require any down payment up front. Now, one of the limiting factors is that your income cannot exceed 115% of the median income in that area. Now, another benefit to the rural development loan is that it requires a lower mortgage insurance premium than FHA, which we're going to go over that in a little bit more detail as we go through this video as well. And obviously, this is for buyers who are looking to purchase outside of the city limits or in a rural or suburban area. So let's real quick just kind of break down. The two main options are going to be the conventional fixed rate mortgage or the FHA mortgage. So this is just a good representation of sort of what the differences are between an FHA mortgage and a conventional mortgage. So I'm just going to use where I live. I live in a county called Midland County, Midland, Michigan. And so our median sales price in Midland, Michigan is $225,000. So I'm just going to mock the deal up based on our median deal. So, just sort of do this math or apply it to wherever you live. So on a conventional mortgage, because we're talking mainly to first-time home buyers, so let's go with the lowest down payment, the 3% down payment. You're going to have a down payment on a $225,000 purchase of $6,750, a loan amount of $218,250. So that's the purchase price minus the down payment. Let's say that you have an interest rate of 6% because that's the average interest rate for conventional mortgages right now. You're going to have a monthly payment. This is just principal and interest. So we're not talking taxes and insurance. Just principal and interest. You're going to be into a monthly payment of $1,308. So that's the big number. That's the one that everybody's thinking about. So keep that in your mind. Now, here's the thing. When you take out a conventional or an FHA mortgage, you're going to have to pay a monthly insurance premium for that mortgage. For a conventional mortgage, it's called PMI or private mortgage insurance. For an FHA, it's called MIP, or mortgage insurance premium. So keep that in mind. Now, when you take out a conventional mortgage, you are not going to have to pay a mortgage insurance premium up front. So you're going to have a zero MIP at the time of closing. And then you're going to have a PMI insurance, but only until you have a 20% equity position in the house. So once your loan to value ratio is less than 80%, in other words, you own more than 20% in equity in your house, then you will no longer need to pay that PMI. So that's important because let's say that PMI, once that drops off, now your $1,300 a month payment is going to go down by $100 to $200. So now you're going to be somewhere between $1,100 and $1,200. Okay, so now let's compare that to the FHA mortgage. Now the FHA mortgage requires a 3.5% down payment. So your down payment is going to be a little bit more with the FHA mortgage. Let's say it's going to be $7,875. Your loan amount is going to be a little bit less because you have a higher down payment of $217,125. You generally are going to get a little better interest rate in most cases with an FHA, on average of 5.84, again, as of this time in March of 2026. So your monthly payment is going to be $1,281. So about, let's say, $20, $30 less per month, principal and interest, than the conventional mortgage. However, in this purchase, your mortgage insurance premium is going to be approximately $154 a month. Now, what's important here is that I'll skip a line. This is for the life of the loan. So this will never drop off. You will always pay the mortgage insurance premium, or the PMI, on an FHA mortgage. Another thing is that with an FHA mortgage, it is required that you pay a portion of the mortgage insurance premium up front. In this deal that I mocked up, it's $3,800. So you're actually going to be required $3,800 additional dollars at closing, on top of a little bit beefier of a down payment as well. So again, there's no right or wrong answers, and there's no which one is best and which one is worse. It's just which one is going to be best for your particular situation. Now, something that I've learned in my career, and that I'm still every day trying to learn more about, is ways to leverage different principles, concepts, and strategies to be able to be more creative with the financing, to maybe make some options work that otherwise couldn't work just as its normal option. So something that's becoming increasingly popular are rate buydowns. And there's three main rate buydowns that I'd like to teach any particular buyer who's looking to learn more about this. The first one is a temporary rate buydown. Now, this is becoming extremely popular with home builders. So what they'll do is they'll bake into the price being able to do a temporary buydown for a buyer when they're looking to purchase a home, to make the house more affordable in the first couple of years. So the most popular buydown strategy is the 2-to-1 buy down. So what this means is that the seller will purchase a more favorable mortgage rate for you that will sort of prevail to the final actual mortgage rate that you'll pay for the life of the loan. So a 2-to-1 mortgage buy down, in year one, your rate is going to be 2% less than what it's going to be at its full amount. In year two, it will be 1% less than what it will be at the full amount. And then in year three, you will just pay the full amount as it relates to the interest rate. Something that you need to know is that you can't sort of get in over your head, and this is sort of what differentiates it from a ARM, or an adjustable rate mortgage, in the fact that before you can even take out this mortgage, you have to qualify for the full rate in terms of debt to income ratio in order to qualify for this mortgage. So you don't have to just qualify for the better interest rate and then you end up in over your head after 3 years. You have to be able to qualify for the full rate right out of the gate. Now, the next thing that I want to talk about as it relates to rate is the phrase that you hear, especially real estate agents talk about it all the time, is marry the house and date the rate, which I like that saying, but I only like it as a principal concept. I do not like it as a strategy, because here's what you need to know is that you don't want to go into the home purchasing process saying, I'm going to bite this bullet on this rate that I can't really afford because I'm just going to refinance out of it when rates get better. Well, here's the thing. You don't know if or when rates will get better. So if that's the catalyst that you're using to make your decision on what house to buy or what rate to accept, then it's a potential recipe for disaster. However, if you're going into it and you know that you can afford the rate, you just, would like to maybe someday get into a better rate, then, you really need to be cognitive of, is this the right house? Because you're marrying the house and you can always refinance out of the rate if rates improve. But what I don't want you to do is use this as a strategy, banking on rates improving when they may or may not in the short term, or even in the near future. And then the last thing is discount points. And now this is becoming one of my favorite strategies with seller concessions, which I just did a great video on seller concessions, which I'll link right here or right here. And you guys can go and watch that and understand how this works. So basically, what a loan discount point is you can pay money up front to actually get yourself a more favorable interest rate. So in that deal that we just talked about with a $225,000 sales price, if you paid 1% of that total sales price, your interest rate would actually go down by about a quarter of a point. And if you paid 2% of that sales price, then your interest rate would go down by a half a point, and so on and so forth. Now, here's what's becoming one of my favorite strategies. If it's possible, attempt to negotiate with the seller to contribute towards your closing costs, or this is called seller paid concessions. If you're able to do this, what you can do is ask the seller to contribute to your closing costs, which you can use that money to purchase loan discount points and actually get yourself a much better interest rate. So what that's going to do is going to directly impact your monthly payment over the entire life of the loan. So let's say that you're able to negotiate $10,000 in seller paid concessions. Then you use that $10,000 to purchase loan discount points. If you do that same $10,000, it would actually require you to negotiate over double, approximately $25,000 of a discount in order to get the same impact on your monthly payment. So this is a very powerful strategy. On the flip side, if I'm talking to a seller here, if you're a seller and somebody's attempting to negotiate a discount on your house, let's say $10,000, instead of offering them $10,000 as a discount on your house, consider offering them $5,000 towards loan discount points. This will actually benefit them the same amount, but will net you a higher proceed. So moving on through to the mortgage pre-approval process. So the lender is going to look at your credit as one of the main catalysts, and your credit is going to be the biggest single factor that's going to impact your mortgage interest rate. So this is just sort of a breakdown of what you can expect for how your credit score actually affects your mortgage rate. Now you can see, obviously, you're going to have the most amount of options. If you have a 740 or better credit score, you're going to have all of the loan options available to you. You're going to have the best terms available to you, and you're generally going to get the lowest available interest rates. If you have between 700 and 739, you're generally going to still have all of the mortgage options available to you, but your rate will be impacted slightly. If your credit score is between 620 and 700, you're still going to have all of the options generally available to you. However, you're going to start to see noticeably higher interest rates, and you're probably going to pay higher PMI rates as well. 580 to 620, you're going to start to lose some options off the table. Obviously, you're no longer going to have conventional or RD available to you, but you can generally still get an FHA or a VA mortgage. You're definitely going to have a higher interest rate, and you're going to have other limiting factors as well. Now, if you get under 580, they say that you can still get an FHA mortgage, but you have to have at least 10% down. You're definitely going to be stepping into some very high interest rates. I've never personally seen somebody with a credit score lower than 580 actually get to the closing table. However, I'm just going off the guidelines based on my research for my article and for this video. Now, we talked a little bit about the phrase DTI, or debt to income ratios. So basically what they're doing is taking your monthly debt payments and dividing it by your gross monthly income. Now, every loan product has different requirements, and every lender from one lender to another has different requirements in terms of what they can accept for your debt to income ratio. However, the good rule of thumb is no more than 43%, all the way up to sometimes 50%. Again, a lot of extenuating factors go into whether or not you can get one done at 50%. But if you think somewhere in the 43 to 50% range, that's a pretty decent rule of thumb. And then, of course, we talked about the 20% down myth. A lot of people think that you have to have a 20% down payment in order to purchase a house. It's just simply not true. There are tons of different loan options, as we've talked about, that require less than 20% down. Actually, most loans require less than 20% down. It's going to impact, again, your PMI and all of these different things that go into the big picture, but you don't need 20% down payment in order to purchase a house. So one of the last things that we're going to talk about is one of the most important things that we're going to talk about, and that is the hidden costs, or the costs that don't really come up in conversation when you're thinking about purchasing a home. Generally, when you're thinking about purchasing a home, you're thinking, I need my down payment, I need money for an appraisal, money for an inspection. But we're going to talk about some of the other things that you need to consider when you're going into the home buying process. Now, the first one is closing costs. Now, closing costs are just a fee for all of the services that are required in order for you to consummate a real estate deal. A good rule of thumb, depending on your price range, is anywhere from 2 to 6% of the sales price, or 3 to 5%, whatever you want to say. Generally, it's going to be a few $1,000s. So make sure that you have at least a couple $1,000s allocated for your closing costs. The second one is PMI, or mortgage insurance premium. With some loan options, you're going to need to have some money up front to pay this. It's generally going to be baked into your closing costs, but again, you just need to know about it prior to the home buying process. The next one is the true monthly cost. Now, you heard me talk about principal and interest, but not taxes and insurance. Now, here's how most mortgages work. Most mortgage options are going to require you to hold escrow accounts. An escrow account is just a fancy word for savings account. So when you make your mortgage payment, you're actually making 4 different payments. You're making a payment towards the interest that is paying down the balance of the loan. You're making a payment towards the interest. This is the price of the money. And then you're going to make a deposit into an escrow account of 1/12 of your annual tax bill. In other words, 1 month's worth. And then finally, you're going to make a deposit into a escrow account that is equal to 1/12, or 1 month's worth of your annual insurance bill. These escrow accounts are going to hold these funds until the bills become due, and then there's going to be a piggy bank or a savings account that has enough money to pay that bill. And that way you only have to make 1 payment a month. Everything all happens automatically for you. Next would be that lenders are all different. Their fees are different. Their origination fees, their processes are different. My best advice is to shop lenders. What I do with my clients is I send them the contact information for 3 different lenders. I tell them to call all 3 because, again, just like purchasing a used vehicle, you wouldn't just go to one car lot that only sells one thing. Everybody has pickup trucks, but every pickup truck is kind of different, right? Ford is different from Dodge and Chevy. They're all different. And maybe you just like one better than the other, or maybe one just fits your situation better than the other. So shop a couple of lenders. Next is reserve funds. Always make sure that when you're purchasing a house, you're not putting yourself cash broke. You never want to do that. You always want to make sure that you have at least enough to cover a couple of months of housing costs when you're going into the home purchasing process. Otherwise, maybe you're not quite ready. And then know the difference between the pre-qualification and the pre-approval. Pre-qualification is basically just whatever you say theoretically you would be qualified if all of that is true. A pre-approval is where the lender actually verifies, collects your pay stubs, collects your bank statements, gets a verification of employment, all these different things. Then they can essentially guarantee that as long as nothing changes between now and when you close on your house, you will be approved for that mortgage. Now, what you can expect in terms of the sequence is to get your financial readiness in place first. You can go out and pull your credit report, I think once a year, and it costs like $30, but it will actually give you your credit score. There's a difference between your Credit Karma score and your FICO score. The lenders are only going to look at your FICO score. So if you think that you're good to go because you looked on Credit Karma, that is probably not what your actual score is. So go get your FICO score. The second thing is to calculate your own debt to income ratio. And this is going to give you a good idea of sort of where you're going to be in terms of price range. And then make sure that you save up some money. that you have enough money for your down payment, you have enough money for your closing costs, then that you're financially ready. The next thing is go out and get pre-approved. You can meet with your local real estate expert. They will generally know all of the best lenders in the market and be able to put you in touch. They're going to need your W-2s, your pay stubs, your bank statements. They're going to look at all your credit, your assets, your debts, all that kind of stuff, and they're going to give you a pre-approval. Make sure you get a pre-approval. A pre-qualification is not going to be good enough. The next is that you're going to work with a real estate agent in most cases, 88%, almost 89%. So call it 9 out of 10 home buyers purchase their house being represented by a buyer's agent. So, and again, a good real estate agent is going to be able to give you tons of guidance on this process and the rest of the home buying process as well. After you found your house, you make your offer, you negotiate your terms, everything's good to go. You apply for your mortgage, you're going to go into underwriting. The underwriter's job is to cross all the T's, dot all the I's, verify everything, make sure that everything's good to go, give you a big green check mark, and approve your loan for you. Final thing is closing. So according to a law called TRID, the lender has to disclose all of the financial pertinence and everything about all of the details of the deal 3 days prior to closing. So they're going to send you what's called a CD, or a closing disclosure. It used to be called a HUD-1 statement, and you're going to sign off on that. Within 3 days after that, you have to wait a minimum of 3 days, then you can close on your home loan. So that's a gist. If you want more, I have an article that goes a deep dive into all of these different, it's a full comprehensive guide on everything that I believe that a home buyer should know about the mortgage process. But the bottom line is to choose a loan built for your situation. There is not a one size fits all. So what you need to do is go through, learn, ask your lender, teach me about all of the different loan options, mock up different scenarios, educate me so that I can make the best decision as it relates to which mortgage is going to be right for me. The next thing is be ready. Know your credit score, know your debt to income ratio, know all of these financial pertinence that we talked about going into the mortgage process. This is going to streamline the process, but also make you speak the language a little bit more, and you're going to be a lot more effective going through your pre-approval process that way. And then again, I live in the state of Michigan, so I wanted to talk about it, but I didn't really get into it because this is for everybody. But in my state, there's tons of different other options like down payment assistance and first-time home buyer programs, all those type of things. Almost certainly there will be those in your state as well. So explore those options. Have your lender describe all of these different possible scenarios to you. This is really going to help you as you purchase a home. So that's it. Again, I'll link my full article up here. You can go through it if you want more information. If you like this video, please give it a like and a share. And as always, thanks for watching.